Welcome back, you legends. I'm Dr. Cal. Let's get right into this video. This has been a crazy trading day and a crazy trading week, so let's get right into it. The S&P 500 today closed up 2%, the NASDAQ up nearly 3%, and the Dow up more than 1.5 percentage points. Taking a look at the stock market map, we can clearly see really bright green all over the place. Really, the only muted price action that we've seen today was in the more defensive sectors of the market, like consumer staples, like healthcare, and like utilities. Energy was also muted today, and that's because this is one of the more interest rate sensitive, inflation sensitive sectors. So as inflation rages, energy moves up, and as inflation calms down, energy moves down. And today we had the inflation report come out, and the reading came in at 8.5% below expectations. This was the first reading in several months where we had inflation come in below expectations. Inflation growth month over month was 0%, so we did not see inflation accelerate this month. This is really good news. Tomorrow we will have the jobless claims and the producer price index. The producer price index, in my opinion, is a more important indicator, is a more important inflation measure, and that's because the PPI tends to lead the CPI. Why? Because as a producer, you tend to set your prices based on your cost. So as long as your cost is rising, you tend to increase prices. So if the PPI comes in also below expectations tomorrow, and if we see the PPI start to cool down, that will confirm the reading of the CPI, and that will be very bullish for the market. On Friday, we have inflation expectations. Again, a cooling CPI and a cooling PPI will also cool down inflation expectations. That's exactly what the Fed would want, and that would be bullish for the market. Now let's take a look at the performance of the different sectors. Again, tech, cyclicals, and communication services leading the pack. This is a full-on risk-on move. Risk-off sectors like utilities, defensives, and healthcare were the laggards. Again, this is very, very, very bullish price action today. Let's take a look at the daily chart for the S&P 500. Massive gap up, massive gap up. Remember, guys, yesterday we talked about how the options market was actually pricing in a $5 move on the SPY. The SPY ended up moving $8.6 up, 2 percentage points in the green, nearly closing at 420, right? Very, very close to 420. We closed up above the June highs. Remember, guys, according to seasonality in midterm years, we do not tend to close above the June highs. So this is very bullish, and we are a spitting distance away from the May highs. And again, there's a very critical zone that I want to talk about, and it's this, guys. I've drawn up the Fibonacci retracement levels from the top of the market back in January to the bottom in June, and we've never had a bear market rally where we closed above the 50% retracement level without the bear market ending and this being the low, right? This statistic goes back to 1950. Every single time since 1950, after seeing a significant sell-off, if we recover the 50% retracement level, that would mean that the bottom is in. This is the bottom, right? And where is the 50% retracement level? It's sitting right here at 4227, 4428. So really a spitting distance away. It's nothing. So we could easily close above this level tomorrow, and that would be massively bullish for the stock market. But again, guys, this does not mean that the stock market could not see a massive sell-off. All this means is that the June lows will remain. They will not be broken, but we could still see a significant sell-off that takes us very close back to the June lows. Remember, guys, we have this gap right here. We never filled this gap. We gapped and ran. We never got back to that level. So this would be a logical level to think about when it comes to a retest of the lows, assuming that we break above the 50% retracement level. If we do not break the 50% retracement level, that keeps the door open for lower lows later in the year. And remember, guys, seasonality for midterm years, we always tend to have a second dip in September, in October, leading to those election results in November. If you look at the red and purple lines, the second year new Democratic president and the Democratic president midterm years, right? And in the red and the purple line, we tend to break the June lows in October. And in the case of the purple line, the Democratic president midterms, we tend to break even earlier than that in September, right? These are the June lows. We break them in September and then we retest in October. And the red line, we come very close within spitting distance in September, and then we break the lows in October. So what will determine whether we make a new low or whether we simply test the lows and begin to move up is again the retracement level on the S&P 500. So I'll be watching this very closely. I am still leaning bearish, guys. I still am positioned for that drop in September and in October. I think the market is super frothy at the moment. It is massively overbought. This rally has been insane, and we are definitely going to see a pullback. The exact level is up for debate, but again, this 50% retracement level will serve as a guide. If we break through that, if we move to the upside, statistically speaking, the low will probably be already in, and we will be looking at other gaps for a retest. We have a gap right here at 3,800, another gap around 3,650 right here. So these will be the levels that I'll be looking at for a pullback, assuming nothing crazy happens, assuming nothing unexpected happens in the world, no wars, nothing crazy with China and Taiwan. All things calm down. We will see what happens tomorrow. Now let's get back to the S&P 500, the daily chart. We have this resistance line. We slammed into this resistance line after this massive move to the upside. This gap is absolutely humongous. It's a $6 gap. Oh, and not even six. It's $7.5. This is a massive gap, and this gap will definitely be closed sometime in the future. Okay, there's no doubt about it. We are massively overextended on the momentum indicators, and if you take a look at the 2-hour chart, the smaller time frames, we slammed right into this resistance line. We've actually made a bullish crossover, but again, this could still turn around, but this is a bullish sign overall. Yesterday, I covered 7 out of 8 sell signals. I follow a lot of sell signals. 7 out of the 8 triggered yesterday, and I want to go through some of them. One of those sell signals is this triple negative divergence on the S&P 500, where we had a high, a higher high, and then a higher high right here, and then we made a lower high and then another lower high. So this was a triple and negative divergence. This divergence is still in play as long as we do not break this high right here. This divergence is still in play, but generally speaking, guys, a quadruple negative divergence is extremely rare. More than 4 negative divergences, that basically cancels this signal out. So that's one signal. The other signal, guys, the other sell signal is a candlestick pattern, right? This massive rejection candle, that was a sell signal, and then we had a third sell signal, and that third sell signal is if you follow Elliott wave theory and counts, we had a 9 count on the 8th of August, and this closed below. This candle confirmed the 9 count. The theory is, guys, that uptrends and downtrends move in 9 and 12 counts, right? If the trend ends on the 9th count, that confirms a reversal is coming. And again, same thing on the 12th count. If we get a reversal on the 12th count, that signals a reversal. We had a 9 count right here. Unfortunately, this massive gap to the upside invalidates this 9 count. So this sell signal as of today has been cancelled. One other sell signal that we've been waiting for is the VIX sell signal. We've been waiting for a bullish crossover on the momentum. We did not get that. We got really close yesterday, but we did not get a bullish crossover. More than that, we had this massive bearish engulfing candle in volatility, and so a lot of volatility has been priced out of the market. We had a lot of implied volatility baked in running into the CPI report because it was an important binary event, and the event has resolved to the upside, leading to this massive decline in volatility. This decisive break also basically ends this uptrend in volatility. This basically confirms that the uptrend in volatility is over. This is another sign that the market has probably bottomed. Again, guys, this does not mean that we don't get massive sell-offs in September, October. It just means that we have probably made the bottom in June, at least in the NASDAQ, and it remains to be seen if we've made the bottom in the S&P 500 or not. Tomorrow we'll add another data point to look at that 50% retracement level. Now, again, looking at the weekly chart of the VIX, we had this blow off top right here and in the momentum, and then we actually crossed down, and the momentum has been declining ever since. Even after the second test, we could not get near the highs And then again, we made even lower highs right here in June as we put in that low, that June low. So again, the VIX is signaling that this might be the medium term bottom. But I did go back and I did look at at all the previous times that this formation happened, this topping formation in the VIX, and I did in fact spot a really similar period in the past, and it's not a good one. Unfortunately, guys, it's a really bad one, and it's this. Just before the financial crisis, right? We had this blow off top right here. We rejected once and twice, right? We had new highs in the VIX that did not get confirmed by the momentum. And then we had this massive decline in volatility and a rally in the stock market, right? So we could be looking at something similar where the volatility dies down and we get a continuation of the bull trend for a little while before that massive sell-off, that crash comes in with the recession. But remember, guys, even though we had this massive inversion in the yield curve, and every single time we had an inversion in the yield curve, we had a recession follow in the next 12 to 16 months, this tends to be a leading indicator of disaster to come. Because the last time we had a inversion similar to this was back here in 2006, and again in early 2006, and then in mid to late 2006. And we did not have the recession or the market crash come in until after this massive steepening in the yield curve, right? So the crash came in about 2 years later. And then again in 2000, we had this inversion in the yield curve in early 2000. This yield curve, on the other hand, really coincided with the crash. As we started to invert, the stock market actually started to crash in late 2000, so this was much closer to the crash. But again, guys, this tends to be a leading indicator. And right here in August 2019, we had the inversion of the yield curve, and the market did not crash until about 9 months later. So a crash is definitely coming. A recession is on the way. There's no doubt about that. The question now is a matter of time. When does that come? And the stock market does tend to perform really well as the yield curve bottoms out, right? And begins to move up. And the crash does not come in until after the yield curve begins to steepen significantly. In fact, I will add the S&P 500 to this chart just to show you what that would look like. And look at that. We had this massive blow off top after the yield curve inverted. And right here, guys, we had this massive blow off top, double top formation after the yield curve inverted. And in 2000, it came in really close to when the market actually topped out. The market topped out in March, and the yield curve started to invert in February. We did not get that massive crash until late 2000, in September of 2000. So it remains to be seen what happens here, guys. Again, this is a leading indicator. Timing it is really hard. It is the hardest part of trading the stock market, timing these massive crashes. But so far, we have a few indicators to look at. One is that 50% retracement level that we talked about. And another one is what we saw with the VIX. Now let's take a look at the dollar index. The dollar index finally broke down out of this ascending channel. So the dollar is now officially out of this bullish uptrend. The dollar will now continue to move down, and that move down in the dollar will also coincide with a move down in the 10-year yields. As inflation is cooling down, the 10-year yield will cool down with it. We will see if we get a head and shoulders pattern, right? Something like this, where we get another shoulder to confirm the downtrend. We will see if that happens or not. But so far, the 10-year yield appears to have topped out right here in June, as the market has bottomed out in June as well. Let's take a look at the Russell 2000, the small cap stocks. We've actually broke the the May highs. This is very bullish. We broke the June highs and the May highs, so this is a very bullish development. And we had this massive run up today. We gapped and then we kept on moving up. So this is very bullish, and it indicates that the meme stocks, AMC, GameStop, and all of those stocks might have some more room to run, because look at this reversal candle. We had this rejection at the very top, then we had a confirmation of that rejection, right? Very similar to what we had right here back in March. A rejection candle, and I move to the downside. We are now seeing a rejection to the downside, right? The price is being rejected here and is moving up. So this is very interesting. Again, we still have that critical data coming in tomorrow. If that data does turn out to be bullish, we might see those meme stocks, AMC and GameStop, go crazy, absolutely insane. BBBY, Triple BY, Bed Bath & Beyond. Again, we're making actually higher lows. Even though we had a rejection candle and a decisive move to the downside, today's CPI report completely reversed that back to the upside. I still like Bed Bath & Beyond. I like it on fundamentals. I talked about it in the last video. I love this double bottom formation. I like the valuation on the stock. It's trading at a valuation of $900 million, and they rake in $7 billion in revenues. They are making, they're a loss-making company. They are losing money, but usually this is the best time to get into stocks, when the company is actually losing money and is just about to turn back into profitability. So if the company turns profitable again, this move will continue to the upside. Now let's take a look at Tesla. Tesla has been a little bit messier than the rest of the stock market. We had a higher high today on the S&P 500, but Tesla did not manage to make a higher high. We have a bearish crossover on the PPO, the MACD. The PPO and the MACD, guys, are very similar. The PPO tends to be more accurate for longer time frames, like weekly, monthly, and so on. So I tend to prefer the PPO to the MACD. But again, a lower high today on Tesla, and a red candle, unlike the IWM, the Qs, and the S&P 500, where we had a decisive green candle. Again, the triple Qs, we got very close to making a new high today. We took out the June highs, and then we are getting very close to taking out the May highs as well. In terms of smaller time frames, let's take a look at the 2-hour chart. We still have this negative divergence, guys. There's still a negative divergence. We keep making higher highs, and the momentum has been going down. So again, it all comes down to tomorrow. It all comes down to tomorrow, whether this bear market is over and we start a new uptrend, or have started a new uptrend. Depends on what happens tomorrow. If we do not manage to take out that 50% retracement level, the bears will have a field day. It will be absolutely insane for the bears. But if we do end up taking it out, we could still see a nice pullback, and then we could see a nice rally. One last chart that I want to show you guys is the Semiconductor Index. This is the SOX, the Semiconductor Index, and look at this beautiful, beautiful channel that we are in. We had a rejection right here, another rejection right there, and then we had a 30% rally, 30% from the bottom to the top. Absolutely not so insane, right? And then we had a rejection. I tend to think that the Semiconductor Index has actually bottomed, right? We had an inverse head and shoulders right here. I talked about this bottom back here. In fact, I was talking about Nvidia and AMD religiously almost every day, saying that this is a beautiful, beautiful level to accumulate. Not only that, I did in fact buy $100,000 worth of AMD shares right here at $77. I got really close to the bottom. And look at that. AMD respected this channel all the way back into November of last year, right? Rejection, broke through. So this is very significant for AMD. Where we go back next, I do not know, but I would love to see AMD retest the lower edge of this descending, this ascending uptrend channel that I have. This is a long-term channel that goes back to 2016. We've been trading within this channel perfectly for 6 years now. So a second test of this lower edge of the channel would be absolutely amazing for me to buy more shares and to get into leap options. I haven't yet gotten into leap options on AMD, but I'm looking to do that, as well as Nvidia. We had that horrible report from Nvidia a couple of days ago saying that they've cut their revenue forecast from $8 billion, 8.1 down to 6.7. That's a massive haircut. And we saw this move to the downside. I expected a lot worse. I expected a lot worse than that. This pullback was, let's see, about 11, 12%. That's pretty much nothing in the context of this massive downtrend. And this is actually a bullish sign, guys. When you see really bad news, like the company cutting its revenue forecast by nearly 20%, and then all you see is this 10% pullback, that's very bullish. This usually actually marks the bottoms in bear markets. So again, in my opinion, we've actually bottomed right here. We had a, excuse me, we had this inverse head and shoulders formation, and then we broke out of this descending wedge. Right, the first day we closed above it, we had this massive rally to the upside. Again, I'm not into Nvidia yet. I did not buy any Nvidia shares or Nvidia options. I'm still looking at a retest of this descending channel again into September, into October. I don't want to get ahead of my skis. I want to wait. I want to wait for that double dip, that delicious dip that comes in September, October in midterm years. It came in every midterm year, guys. Every single midterm year, we had another dip in September, October. So I'm waiting patiently for that dip to come in. And in fact, I'm still positioned bearish to take advantage of the move to the downside in September, October. I do want to mention, guys, that I do share all of my trades, my losses, my gains, every single trade that I make, winners and losers, and trade ideas, and a bunch of charts in my Discord group. If you want to support me, you can do that. It's $20 a month. You can buy me coffee once a week, and you get to access all of that good stuff and then some more investment ideas, things like that. So if you want to support me, you can do that via the Discord group. You can find it in the link in the description below. And if you want to support me in other ways, you can comment, you can like. That is always welcomed. That's all I have for you today, guys. Thank you so much for watching. Please keep your eyes peeled for tomorrow's job numbers and PPI and that 50% retracement level, this delicious, tasty level right here for what happens tomorrow. Thank you, and I'll see you in the next one. Bye-bye.
Oh, wow.